We had the jobs number today, and the jobs number was about 177,000 new job additions, and I believe there was a bit of a revision for the previous month up of about 40,000 or so. Which is all fine and dandy. The only issue was that they were expecting 220,000 jobs, and 177. That's a pretty big miss, and that was justified by a lot of analysts and I guess people who they put on TV, the intelligentsia. They were saying that it's a seasonal issue, no big deal, and it was pretty much all steam ahead for Fed rate hikes in a couple of weeks in September. So that's why I guess the market today had a bit of a hissy fit and was down. I will note this. The news and the reaction to the market of its news always tends to fall along the line of least resistance. And we know we've been in a bear market, I will say. I mean, it certainly feels that way, and a down tape here. And I guess the reaction to news on a down tape is to go lower, just like the reaction to news on an up tape is to go higher. Anyhow, it hasn't been helped that we have the Fed Vice Chair, the Stanley Fischer, who's a South African-born gentleman. He also has dual citizenship in both the United States and Israel, but yet he is the Fed Vice Chair. Anyhow, he has been more hawkish. He's been talking real tough about raising interest rates and, the path to normalization. And there are a couple of other kind of blowhard hawks on the Fed. Jeff Lacker, who was really late and wrong on the financial crisis. He's out of Richmond, Virginia. He gave a whole speech today about how the Fed is going to, the dangers or what have you of staying lower and that they should go. You also have Dennis Lockhart out of Atlanta in Georgia. He's their Fed chair. He was also really wrong during the financial crisis. A lot of tough talk. And you also even have retired Fed chairs who now, I'm sorry, not chairs, but Fed members like Richard Fisher, who used to be the Dallas Fed chair, who's just a complete insert expletive. He's been really wrong for a long time as well. You've had some more measured comments out of New York Fed President Dudley. He is talking about the volatility and that the Fed should probably stay lower for longer. And my thesis is that we had a revision up in our GDP estimate. I forget the exact number. I think it was from 3.2 to 3.7 or 2.7 to 3.2. One of those. I have my end numbers there a little mixed up. The issue there is that the growth estimate for the second quarter was raised. I shouldn't say the estimate. The actual number was raised. The problem for me with that, and that is a big revision, no doubt. I'm glad that happened. The issue is that the first quarter was so weak. It had been negative, and they revised it up to 0.6. And I think which was kind of just over the growth line. So the issue there for me is that I think that a lot of the business that should have taken place in the first quarter was pushed into the second quarter and kind of padded that number to be higher. So yeah, it appears like it was stronger growth, but it really wasn't. It was sort of just a catch-up from what was lost in the first quarter. In addition, this has been sort of lost. I've heard it mentioned, but a lot of people are missing this, is that they subtly revised and I wrote about this in an article, they've revised the growth estimate, or I should say the actual numbers. I keep saying estimates, but it's the actual numbers for the last 3 years lower, the mean, as well as potential revisions for the prior 3 years ahead of that. Growth is not where it needs to be. The Fed has been talking about full employment numbers, and the headline number, as it is read off, believe it or not, is really low. It's about 5.1%. That's full employment, correct? The problem is once you dissect the number and you look into it a little bit more deeply, sort of like, you would use market profile to look into a day's trading, one candle's trading action, you'll notice that the quality of the jobs aren't that good. There's been a bloodletting in, I would say, manufacturing jobs. We all know the oil companies are starting to lay off. I believe ConocoPhillips was laying off like by the tens of thousands the other day. And the job additions are coming in the service industry, meaning waitresses and bartenders. Yeah, there was a little bit of a tick up in the hour, the amount of take-home pay, but it is still considerably low. And one of the reasons why the jobs number is so disturbing and misleading is that the amount of Americans, the labor participation, is the lowest it's been in my lifetime, in 37 years. That you could say that it's a result of, I heard someone on the stream saying it's demographic changes. Yeah, you tell that to the people in Baltimore and Ferguson, or who are poor people who are rioting. The jobs, I guess, the economy is not well. The point I'm really trying to drive home here is that growth is rather slow. It's stall speed at best. It is very vulnerable to shocks, similar to the ones we are getting out of China and the rest of Asia, as well as the European markets and the periphery of the EM. The Fed has been warned twice by Christine Lagarde's. I don't believe it was her, but I believe it was her vice chair. I forget what his name is, from the IMF. Anyway, the point is that the IMF has warned them not to raise interest rates this year. The World Bank has done the same. And now the G20 is chiming in, asking the Fed to stay lower for longer. That is my theme. It is still my theme. I don't believe that the Fed is going to raise interest rates here. I believe that the volatility in markets, financial markets, are very high. And I believe that the Fed's purpose the last few years, and they've done an amazing job at this, my hat is off to them, is to lower volatility in markets and give the global economy a chance to deleverage in sort of with kind of a safe zone. The people, yes, they're kind of talking down the markets. I think they're trying to avoid a 1929 blow off top. I've done a lot of studying and reading on of the Depression, and one of the tools that the Fed used then, it didn't work then, and I don't believe it will work here, is they try to use moral suasion. They've tried to talk down, the threat of your big brother, right? Like, don't beat me up and take my lunch money because big brother will take care of you. And I've heard a lot of these TV commentators, and I don't want to call anyone out by name, but I think if you watch some of the more popular networks, and I often single out one because they're kind of the more well-known, but I flip through a bunch of them, and there's a lot of people on there who just don't know what they're talking about. And they'll say, the Fed just needs to go to raise for raise sake. We've been this low for this long, and it's time to raise interest rates. And the truth is that a quarter of a point really won't make that big of a difference. It is a very low amount. We are off of a very low basis, really close to a zero basis. But the issue is not so much the amount of the change. It is the fact that there is a change, and it's a move away from a policy of accommodation to tightening. And that would be a very large sea change, one we haven't seen in a while. And the Fed would be doing this into a market that's already in a downtrend, and into an economy that's slow and slowing, as well as a global economy that's slow and slowing. The problems in China are not good. They had their PMIs that were contractionary this week. They were like in the 47s. Anything below 50 is contraction. And, they are in sort of a war with us now, almost, to devalue their currency. They're looking to kind of grow through devaluation. And if you listen to, the TV, they don't really talk about this much. The only person I've really heard who's very vocal who talks about this is Donald Trump, believe it or not. He, in a speech the other day, was talking about how Komatsu, the tractor company, is basically schooling Caterpillar because Caterpillar can't compete. They are having a very hard time competing because the Japanese lower their currency. The Chinese are now going to be doing the same thing, and yet the dollar is now getting stronger. So if the Fed were to hike here, they would absolutely assure a higher dollar. Why is that dangerous? The reason that's dangerous is that if with a higher dollar, companies such as Caterpillar will have a harder time competing overseas. They will not be able to sell their goods into markets as cheaply as foreign competitors, and that'll get even worse with foreign currencies rising. Other companies that have problems with like this are Nike, for example. They do a ton of business overseas. Facebook has complained even about their earnings because of raising the currency issue. Apple does a lot of business in Asia as well now. A lot of their growth is coming from China. The currency is a big problem. I highlighted the other day that there are a few things that the market is looking at here, and these sort of all need to line up for the exactly. We have a trade deficit in this country, and a higher dollar will make that even worse. That can't be good for the country. The Fed. Honestly, and I'll give you the path for the Fed here. If I were a Fed governor or even the chair, which I'm not, obviously, but my suggestion would be is if they really want to ease out of QE, the logical step isn't to hike immediately. It's to just stop the reinvestment. You know, a lot of people don't realize this, but we still have QE light going on here. When the Fed balance sheet, like let's say something expires, they go back and rebuy a new duration of that, and they're kind of still pumping money back into the system. If the Fed really wants to kind of wind down their balance sheet a little bit, they should just stop the reinvestment. That will in a more slow fashion, allow interest rates to rise, and that would be better than them forcing it by selling their bonds. There's also been some talk on, even by me, that the Chinese have been selling some of their U.S. treasuries. If the Fed is selling, and China is selling, and Russia is selling, and God knows who else is selling, that's going to be very bad for the U.S. You know, the interest rates here are going to go considerably higher. You already have companies that aren't comfortable with investing in their businesses, and what they've been doing is buying back stock and paying out dividends. And couple that with kind of the structural unemployment that we have in the country, and I think you'll have a real recipe for disaster, because now you're raising the hurdle rate for projects. You know, the higher interest rates go, the less attractive business plans become. You know, there has to be a certain amount of return to justify an investment, and to raise interest rates, even by the small quarter of a point, is going to take, you know, even incrementally some of those projects down. Like I said, I want to keep repeating this. I had a very large debate on Twitter with a few people this week. It is not the amount of the interest rate hike. That is irrelevant. It is the change in policy into weakness. That is a disaster for the Fed. I really hope they don't make a policy error and do that. I believe that it will have to be undone. Yes, correct. It's a psychological issue. You know, people talk. I mean, more and more the markets are traded by machines. We all know this. You know, the algorithms. But the people who program those algorithms, and the people like you and I, are human beings with real fears and real emotions. And markets can get emotional, and I believe that the removing of training wheels into into road construction is probably not the best path to kind of wean the patient or the toddler off the training wheel bike. You know, you want to do it in a driveway. You want to do it safe. You don't want to do it on I-95 while there's construction going on, or in the middle of rush hour. And the Fed really needs to pay attention here about what's going on. I mean, if you take a look at commodity, copper is crashing. I mean, it's just amazing, the free fall that's happened in copper. Oil is an absolute getting its head handed to it. It's just getting absolutely smashed. If you take a look at Brazil, the Brazilian markets, they're getting creamed. China's getting creamed. Russia's getting creamed. India's getting creamed. All of the engines for growth brick are getting their heads handed to them. The good news is, I will say this, I don't want to get people too crazy here, is that the cure for low commodity prices, the cure for low stock prices, the cure for any low prices are low prices. At a certain point, they start getting to be cheap enough that people are interested in buying stocks. Let's take an example here. Let's just let's get into some of the stocks you guys want to talk about. One I've been a little bit of I pick on a little bit is GoPro. I really don't like their management. I don't like that they unlock stock ahead of their, that was supposedly for some type of a charity or whatever, and it really rubbed me the wrong way. I think that owner was probably smart in the sense that he did it because he knew the stock was going to go lower, and hey, you should always sell as much as you can at the highs, but I think it was very just disingenuous to the public. And you can see today, I've been talking about GoPro getting down to 37 and potentially even to 28, and that did play out. So now that GoPro is down to 37, it's cheap, right? A bargain. The stock had traded at, let's see, what was the high? Almost 100, right? It was like at $98, and now it's $37. This is a bargain. The answer is that it's not. The stock is still trading at 26 times earnings. That is an amazing multiple for a company that makes, relatively commoditized hardware. Yeah, I get it. It's cool. It's in the X Games or extreme sports. But let's compare GoPro to, let's just compare it to Apple, right? Let's just, I realize that they're not the same. Apple is clearly, more diversified in the scope of the products they make. But in all intents and purposes, I think everyone would say Apple is the premier brand in the world, and that they are primarily a hardware company. Apple trades at 12.6 times earnings. Now the question the question there is that what's the difference between the two companies? The answer will be the growth, right? Obviously, GoPro is a smaller company. It should be growing. Maybe it deserves a faster multiple. I had a call coming in here, and it stalled my my. Are you guys still there? I hope this didn't cut me out. No, there we go. It's still going. Okay, good. Anyhow, the answer is that how many people need to buy GoPro cameras? Are you going to get a new GoPro camera every 2 years, like you do your iPhone? It's not subsidized. It's not something that is as likely to break because it probably doesn't get everyday use, although if you're jumping out of planes, maybe you will break it. But how many people are really jumping out of planes and going down mountainsides? And it's ridiculous. This is silliness. This is silly froth in the market. And this is what's coming out when you start having multiple contraction, and you start having people wake up to the fact that the markets are in a little bit of trouble. This is when this type of froth comes out of the market. So that's why you're going to see a stock correct. Someone just mentioned Ambarella. That's exactly what's happening. Ambarella is the supply maker for GoPro. This stock in the lows in 2012, this stock traded at $5.55. It peaked out at $129. Take a look at these charts. They're absolutely, some of them are really parabolic. They're just hockey sticks up, and in the end of a hockey stick up is this. Down, down, down big, and that is what's happening with a lot of these stocks. At this point, that kind of can feed on itself. You already have a rebalancing in the market. I think the Fed was worried about a lot of this. They've gone out of their way to mention social media and biotechs and you name it. So you're already starting to get some of the desired result based on just some tough talk. What do you think is going to happen when they actually pull the trigger and raise interest rates? The answer is you could have a very severe contraction. And I proposed a question today, and I tweeted it out, and I said that if the Fed, the gains from, let's say, 2012, sort of when the QE infinity started, will all of those gains now have to be repealed, 3 years worth of gains? We broke out from the 157s. That was the 2000 and 2007 peak high. And we never have retested it on another leg. It sort of just had the breakout, a very minor check back, and then it just was off to the races. There's a very good potential. I know it sounds amazingly impossible, but when, markets start to the downside, they often go further for longer than you think is rational, reasonable, or even possible at the onset. And a lot of that is out of necessity. There's an overshoot. This is because people are overly long. They bought with margin, and the geometric series is great on the upside, and it's absolutely amazingly painful on the downside. I think a lot of the weakness we've seen is from people who have been long for a while, and some people who have chased. The last year we've consolidated for about 8 or 9 months, and now we kind of have broken through that range's low. So the question here now is this going to be is this just a large liquidation break with a look below and fail, and then we go back up to make a new all-time high? We haven't had we had about a 9 and change correction within the last couple of years. Last year, what was that about? In 2013, I believe, sort of toward the end, we had a little bit of a panic, but we recovered. The question is now do we recover to a new high, or are we going to go significantly lower? My thesis here is that we may have seen the top. And if we have seen the top, and I mentioned this at the time, actually, I had said that we had reached a 1.618 Fibonacci extension from the 2007 peak to the 2009 March lows, and that came into effect up around where we topped out. And I had said that if we have a large pullback, this time might be different. So I am saying that it is possible that we did kind of top out, and that the market might have to go a lot lower. The way stocks kind of rise, I think what amazes me is how few people, I think they kind of know this, but they don't, they know it sort of as a concept, but they don't know it in practice. And I'm going to discuss it quickly here. Fund managers will buy a stock, and they will raise the price of it well past where is reasonable, because they are in size that is different than you or I are in. If you own 1 million shares of something, or 10 million shares, or even a very large percentage of the capital stock, you can't just say limit order and sell everything out at like $100, for example. You need to raise the stock to like 110, 115, 120. And then what you do is you keep, I guess, raising the price until your incremental buying can no longer raise the price any higher. And then what they do is they sell on rallies on the way down. I know that sounds counterintuitive, but that is how it is done. That is how professional money managers exit positions. They elevate the price up to the highest point that they can, and then they sell at the rallies on the way down. There is a lot less scaling. You can see if you turn on the television, there are like almost no one on the floor of the exchanges anymore. So the scaling is limited, and usually what they'll do is they'll just sell the bejesus out of the stock immediately, because they know that they are no longer the ones they're buying it, and they will distribute it into the public, who think that, Netflix is a great bargain, for example, at $100 or 110 or wherever it was. Just because it sold off, X percentage from 129. So that's an example of it. They sell it, like I said, on the rallies on the way down. Let's go through a couple of tickers, and then I think we'll wrap up. So let's talk about some of these stocks. Priceline, I'm just going to go through these in the order in which I wrote them down. They're not going to be alphabetical. So Priceline is just kind of chopping around. It held its 50-day moving average. My fear with Priceline here is that it's looking like a little bit of a head and shoulders pattern. I would say that there is some resistance anywhere. It held the 50 today, which is good. It's held it for the last couple of times. I would be thinking that there's some resistance between the 1264 65s, and like 1280s. Let's just see how that resolves. You know, it's a $1,200 something stock. That seems like it would be a good. It seems like it would be a good stock for funds that are long to liquidate to fund margin calls. That's sort of what you have to worry about. It doesn't even necessarily always, when you're in a down move, become the fundamentals of the company. It comes into the fact that people need to raise cash, and often they'll sell their winners to fund their losers, or, you know, more illiquid positions that they can't get out of. That's why they say that some of these stocks, and this is what happened in 2008 and 2009, was that a lot of these positions that funds were in, and, you know, credit derivatives and you know, some debt, was really illiquid, and what they had to do was sell into the stock market because there was liquidity there. They sell where there is liquidity. We are nowhere near 2008 and 2009 in terms of the systemic type of a risk that is posed to the United States. I just want to say that now. And there is, I am not seeing the type of credit contraction that we saw in that period of time. I will discuss that if and when I do start to see it. I am not seeing it here. So I don't think that the crisis here is nearly as severe as what had happened there. I don't know that we're going to get, you know, I don't know that our correction here is going to be gentle and nice. And that it's, you know, kind of over already. I do believe that there is potential for more room down, but I don't believe that the system is at risk like it was back then, at least not here in the U.S. In China, yeah, I think they are having a 1929-like moment, and I think that they are in for years of pain, particularly if the U.S. doesn't oblige with the rate hike, which I think would be really very foolish of them to do. So the question now lies with where we're going, but that's another conversation. Let's go through some of these other stocks. Netflix, I'll go through quickly. I had warned that had a head and shoulders pattern. It broke the neckline at 103.88. If that was to complete the head and shoulders top, the measured move takes it down to about 78.47. There's a 61.8 Fibonacci retracement at 77.36. So I believe somewhere between, it could retest its old low around 85 and potentially make it down to there. At that point, I would say you could probably buy the dip for some type of a bounce. I think that it would be a little bit too much too fast, and that the stock should have a bounce from there. I'm playing that with, I had actually, I think I had discussed this, that I had played the stock short, outright with shares. I had covered on the day of the you know, I guess the crash, right? It was a crash on the 24th. So I wasn't quick enough to cover at the lows, but I did cover really the exact lows, I should say, but I did cover very well, and I was out of that trade. The stock has rallied again. I have shorted it again, and I'm playing that. The one I've been discussing, and I'll just stick to what I've been discussing, is I've been playing it with put ratios on the stream. Long 80. I have a couple of different versions of this on. I'm long 90 puts expiring next week, and short 2 times the 85s. And in another account, I have the 80/85s, and I added to that today. I've been adding size into that. Those have been for net credits. So guess what? If Netflix goes back to 130 next week, it doesn't cost me anything in those trades because they were put on for net credits. It's sort of just no harm, no foul. I have some similar plays on. I don't want to get into too much of the details here. I will maybe in the weekend video. I have those plays on in Gilead. I've been doing them in Facebook, Apple, a few other stocks that I think have potential for maybe lower. And if they do go lower, it's sort of, I cap it off where I wouldn't mind being long, so to speak, at least for a bounce. And I do them so near dated that if it goes against me and if it kind of blows through, I will be able to kind of roll or do some various other stuff with the stock. With regard to Facebook, someone asked me about that. I'm bullish on Facebook longer term. My issue with Facebook, though, Excuse me. Anyone want to hear what the bear case is for Facebook? I always make the bull case for Facebook. Why don't we talk about the bear case? The bear case for Facebook is that they are highly dependent on, I guess, advertising from startups, about people who sell their apps through Facebook. If you ever go on to Facebook and you see what their advertisements are, they are for people to buy product or for kind of new startup ventures. There's a lot of stuff that comes in from big companies too, but they also have a lot of people, smaller companies, that are doing it. If funding and liquidity dries up for startups, which it's starting to happen, they are going to have less money to put into advertising. And if anyone knows this, what is the first thing companies cut in terms of their budget? It's advertising. And that will be a big smack in the face to Mr. Zuckerberg and to Facebook shareholders alike. They would miss quarter after quarter, and the stock will get obliterated. I don't necessarily know that that's going to happen so quickly. Their growth has been rather impressive, but that is the bear case for Facebook. And that is eventually how Facebook is going to go. That will eventually, most likely, be the demise of Facebook. Are we there yet? I don't know. We kind of got my price target. I had said I thought we would get 100. After that, I sort of was going to reassess, and we got 99 and change, which I guess is just shy of the big hundo number, but it's close enough for government work, so to speak. Anyway, I'm not really that bearish on Facebook in the short term. I do believe that it did have the spike. The problem I said with those spikes down and was that the algorithms log those spikes. That's sort of where the real buyers are, so to speak. And the machines like to try to retest prices. So in the flash crash, we got to 72 in Facebook. It didn't last very long, and the stock wound up closing that day at 82, which is really kind of like the lower end of the support range now, and then we rallied back up. I had said that I thought the 50 MA would be a good area to sell some into, and it has now kind of come back down but bounced. It had some decent relative strength today. I wouldn't mind doing some put ratios. Maybe we could see some of those lower 80 numbers again. I don't necessarily know if we're gonna get to the 72 so quickly. It's possible that we do get there again, believe it or not. I will be very much the first person to admit that I believe that those, and I've said that, I thought for the market and I thought for a lot of these stocks, it's possible that we retest those levels. So just keep that in mind if you're overly long in these stocks, that the algos know, they know, right? They know. So just be a little bit careful. If it does come down early, if we have a nasty gap down on Monday, I would be looking to buy the stock, if we could get somewhere between the 81s and the 83s. That area has been some support. 85s were, a very large top for a while, and that's where the breakdown, I'm sorry, not the breakdown, that's really where the stock really took off once we cleared that. So I think that somewhere in there should be some people who have missed enough of Facebook who are interested in buying the stock. If we do get... sorry, my bad. Not Monday. Tuesday. Just push it to Tuesday. If we have a big gap down on Tuesday, the futures do trade an abbreviated session on Monday. So there's that Sunday night open that we have to keep an eye on. So just keep your eye on that. But on Tuesday, if there's some kind of really nasty gap down, maybe that'll be an opportunity to get into some of these stocks. I had people ask me, I don't want to name anyone on the stream, but I keep getting a lot of people, and a lot of you email me. I really appreciate the emails. I love to know what you're thinking, and sort of I wouldn't say it's tutoring, but I sometimes go through some of them and I give people my opinion, and I sort of see where they're going wrong. The issue I'm seeing that I think a lot of people are suffering from is that they are using too much margin. They want to be sort of extra long at times. When a bull market is going up, you look at it and you say, oh, I'm missing out on gains. I want to catch, every single point. And in a bull market, it's good to be greedy. When price action changes and trend changes, though, you really want to be more opportunistic. If there are some extremes, use those to buy. I've been saying this all year, and if you listen to this, you probably avoided a lot of pain. I've been saying that you should be using smaller size, looking for smaller swings on a smaller time frame. So if you're like a swing trader, you're probably now going to be at least you're going to be forced into being more of a day trader. Or you might be forced, instead of looking for a week's long swing, maybe you get 2 days or 3 days. I would be looking I'm still saying the same thing. I've sat a lot of the year in cash. I'm still very much in cash. I am very opportunistic, though. I will take advantage of trades both on the long and the short side. Bear market rallies are often some of the most violent. It sucks in a lot of longs, and people get complacent, and then they get their throats ripped out when you gap down 1,000 points, like on a Monday or a Tuesday. Let's talk about some levels in SPY. So I'm just looking at the chart here. We failed a couple of times on kind of the rally back. We got into the 197s and the 198s. It was the high here. It was like 190, almost 200, which makes sense. It failed. It wound up breaking back down. We held like sort of the 50% fib, came back up and kind of failed at the 197. So I don't really think you need to be super duper long in anything in terms of stocks unless you can get the S&P back up over those levels. For sure over the 197s and maybe over the 200s. The bad news is that we have a lot of resistance ahead of us now. You have the 197s to 198s. You have the 202s where I really thought should have supported. That got sliced through like a hot knife through butter. Probably there'll be some cutie pies at 200 just because it's a round number. But the real pain trade I think would be is if we got back up to the 204s. That's really was where the real support had been and where the real breakdown took place. That I think will be a real cap on the market. I'm just looking on the volume profile, and that's really where the dead bodies lie. There's really not that much, believe it or not, below there. It would not shock me if the Fed doesn't hike, for example, for the market to get back up to the 204s. It could easily happen. We'll see what happens there. I think it would be a great opportunity to do a right or right out short in as much size as you can stomach with a very, very tight stop. Because why do I say that? Because that is really where the breakdown took place between the 204s and the 205s, 205.38. And if we can get up there, I think a lot of people who have sat through this sort of very nervous but who didn't sell, and a lot of funds haven't sold yet, will be interested sellers there. And I think that if we do roll over from there, that could be the high for years to come, like 2 years. An average length of a bear market could be 18 months to 2 years, believe it or not. And imagine what happens if the market gets down to those 157s and you have good trade location from 204. You know what we call those people? We call them legends. That's a legend type of a move. Anyway, that's, I guess, just a little bit of hypothesizing here. If we do wind up having a bit of a rollover here, like let's say Tuesday is a big gap down, where does that mean we're going? I would think that we could fill the gap potentially to the 187s. That was sort of the day after the day, I guess. What is it? What was it they said in Swingers? The guy behind the guy? The day after the day? Anyway, I think that we could see that easily and maybe even retest the lows down to the 181s to 182s. That area was where the support was before. It wouldn't shock me to see retest. I don't know if it's going to hold again or if we're going to undercut it and go lower. I remember in the flash crash, the 2010 days, we had the initial flash crash, the rally back up, and then undercut that low slightly and then rallied from there. The lows eventually were revisited a few weeks later, a couple months later, and then breached, and we had a much, much, much lower low. But in terms of trading, guys, in terms of trading goes here, I do think that there will be some type of a tradable setup if we get there, particularly if it's sharp and fast. Primary trend comes in down at 168s. So if you can get a rally, like let's take a look at the VIX. I've been talking. I'm going to go through, by the way, my things that I need to see. I've been tweeting this. I don't know if you've been paying attention, but some of the things I need to see for the market to go higher. If we're going to have a sustained rally higher, you really need to see the VIX break and close below 25. Yesterday we attempted it, we closed higher, and then today we rallied. I unfortunately think we're going to need to see another spike up in the VIX, and it's going to have to show the bears that it can make a lower high and that it's not going to take out that 53.29 spike high. That could be a lot of pain. It could be up to 40. It could be maybe even higher. That was sort of the close of that day, 40.74. That would be my target if I were long VIX. Anyway, that's what we need to see. We would need to see for the bulls to take charge again. You need to really see the either a rally to a lower high and then a collapse, or the collapse below this 25.20. I'm just going to say 25 because that's really the key level. If we could get back below 25, I think you take a lot of the crash risk off the table. You also need to see the Fed. I've said this. They need to stay lower for longer. I will say the one thing that was really encouraging to me was today, with all the talking, insert expletive there, I guess the guys behind the bathroom attendant, maybe the guy behind the guy behind the anyway, whatever. These guys, the TLT rallied, which is good. Interest rates went lower. That's really what you want to see on bad news. And you want to see if interest rates today, if you would have had stocks down and bonds down, I would say we are in for a hell of a tussle the next with regard to the markets. But we did have a rally. My only concern is that we didn't get and close over the 123s. That's really where you need to go for the rates to go significantly lower. It wouldn't shock me to see it fill this gap up here to the 126s. We'll see. Someone just astutely mentioned over here, and I've heard this. People were talking about the banks. Amazingly, this has been a highly chased sector. Interest rates are going higher. They're going to buy the financials. You're going to have a yield curve that's steepening. And I think that the deflation coffee was sufficiently passed out here, and people have started to realize that you might have, instead of a yield curve steepening, you might get a yield curve inversion with a recession. That's not going to do really well for the banks. Also, some of the stringent money lending standards that have gone into place have changed these guys' profit profiles significantly. I think also, which seems to be lost, I think a lot of people don't really read these regulations that go into the financial markets, but the banks have been so heavily regulated with Dodd-Frank and some various other regulations that they're not going to be able to make as much money as they might have been. A lot of their business lines have been stripped away, and they're really just kind of like dependent on loan money, and I would say that the demand for money might dry up if there is a recession. There's going to be less people borrowing to buy homes. If you take a look at some of the statistics, some of the housing stats, the percentage of people that rent to own is the highest it's, I think, ever been, maybe. People are really renters here. They just don't have money. They're laden with, credit card bills, these crappy jobs that they're not making any money on. They have a lot of debt. People are up to their eyeballs in debt. I think that the economy has gone under a really major fundamental change in the last few years, and I really believe that we are in a lot of trouble. I believe that the economy, the leadership we've had fiscally, in the executive office, President Obama, and with Congress, they have done absolutely nothing to create growth in this country. I really don't want to get into too much of a political debate here. I think everyone sort of knows I tend to lean more toward the Republican side, maybe quite heavily toward the Republican side, but the blame is to be shared. You know, they are not doing anything to promote growth. They have loaded up the country with entitlements. If you want companies to invest in their businesses and not just buy back their stocks and not just pay out dividends, make it economically viable for them to do so. We have the highest corporate tax rate, bar no other country in the entire world. We live in a global economy where money can transfer and travel very quickly, and capital, no matter how you regulate it, will always flow where it's treated best. We are not treating capital well here. We are demonizing companies. We have been demonizing success. And we are now loading up companies with Obamacare mandates that they are now, it incentivizes companies. And they'll never admit this, but this is what is happening and what is going to continue to happen now that it's hitting the corporate mandate, that they will now hire people part-time. They will, first of all, they'll probably fire people, full-time people they'll fire, or they will scale back on their hires. And instead of hiring people, if they're not out offshoring them at this point, they will either hire them on as a temporary basis as opposed to hiring them as a full-time employee. They can evade those regulations. That is my theory. That's going to be a very big thesis that I'm going to be talking about in 2016. This is a little bit of a preview for it, and I think the unemployment issue is going to get really bad. I don't want to scare anybody, but there are problems. The country is not doing well. So that's that. I'm sorry I went off on a little bit of a more than I would have liked to, a little bit more of a political rant there, but it's really just true. Just take a look at these jobs numbers. You know, we're getting all excited. This has been the slowest recovery after a kind of a crash recession in modern times. And I think that until we really start seeing some pro-growth policies, we've really been reliant on monetary policy to sort of be the adult in the room, and I wouldn't say serve as the engine of growth, but at least has served as the buffer from complete smackdown. This has caused companies, like I said, they bought back stock, they've paid out a lot of dividends. It's been really good for investors, but it hasn't been as good for companies to invest in their long term, and it's very hard to do so when you don't have visibility. It would be really nice if these companies would have some visibility. I think it would do a lot for growth in the country. I think we covered a lot of the bases here. I didn't cover all the stocks that everyone had mentioned, but if you want to talk about those, be sure to check out my weekend review video that is going to be on YouTube. It will be, like I said, on my channel. It's Justin Pulitzer Trades. If you caught this broadcast, sort of intra broadcast, and you want to see it from the beginning, or if you just think you like my shirt today and you want to watch it again, be sure to do that. I think that would behoove a lot of people. I will cover Apple in the weekend review. I promise. I'm sorry I didn't get it here. I will cover it in the weekend review. Just the quick and dirty here, 109 to 110. That's the key. Anything below there goes to 103. Anything above that holds there, you can still see 115s, maybe 119s if there's a rally in the market. If not, it's going lower. Wow, that was pretty quick. Anyway, follow me on Twitter at Justin Pulitzer. Be sure to follow me on YouTube at Justin Pulitzer Trades. I will do the Sunday video. It's going to we open on Tuesday. So here's the question. I'm going to leave it up to you guys. Do you want the video on Sunday night or do you want it on Monday night? Because I will have an opportunity on Monday to see the futures, the Sunday night and Monday futures. If I do it then, I can then comment on that and factor that in. If not, we're flying blind into that. I will not have seen China also. That's also a big thing. I will not have seen China. So everyone wants it on Monday. All right, so okay, so I'll do it on Monday, I guess. I think we have a quorum here, so we'll do it on Monday. All right, so we're going to move, instead of Sunday night video, it's going to be a Monday night video, and this way I'll have seen the futures and China and be able to discuss some more updated levels. Anyhow, thank you guys. I love how democracy works here. I'm going to post that out so the rest of you who missed this will see it. Let's have a great weekend. Try and not stress out too much about the markets. Enjoy, this is the official end of summer. Let's try and get some sun, have a couple of nice drinks, enjoy it, get in that last swim, enjoy the last weekend at the share house or whatever it is you're doing. Anyhow, let's take it easy. Cheers.